would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. We're going to do an interesting show today where we're going to do a little bit of a response to some listener emails. And you know, I want to thank all of you who reach out. And I want to apologize to those of you for whom it has taken me a little bit longer to reply than perhaps you would like. I've had a big jump in the number of emails. Interestingly enough, also a big jump in the number of folks who'd like to be a part of the show. So I'm kind of sifting through that list. I've got a couple that I think are absolute must-dos, and a couple who I want to make sure that it's appropriate for all you guys. But that's kind of an interesting take, so we'll push forward with that and hopefully make that an ongoing part of the show. If you'd like to reach out and get in contact with me, feel free to head on over to therebelbroker.com. You can click on Contact the Rebel Broker and send along any ideas, suggestions, observations, or questions that you might have, and I'd be happy to respond as soon as I can. If you'd like to support the show and also put yourself in the drawing for winning a $50 gift card to Amazon, head to the very tippy top of the show at the Rebel Show. The very tip of the top of the page. See, now other podcasters would edit that little mistake out. Not me, baby. I want you to see all the warts and the not so warty parts. Just head on over to the webpage, head to the tippy top, click on the big red button that says take the survey to support the show. Use the same email address both times you're asked, and you will be, and answer the 4 or 5 questions in addition to that, and then you will be entered to win the $50 Amazon gift card. Now, we've already given out one for the first show that we did in October, and we will do the same thing for the first show we do in November. So, and everybody has a potential to win, right? Even if you entered way back before I started making the offer relating to the $50 gift card, or if you've entered since the last one, doesn't matter. Everybody's in the mix to win a $50 gift card. So go ahead and submit your info, and you're not only helping the show, you're potentially winning 50 buckos for yourself. So good luck to everyone who participates, and thank you to all of those who have chosen to do so. You can also get into the Rebel Underground if you'd like, a very special select group of folks who've decided to jump into the next level of involvement with the show. Just text the word Rebel Broker to the number 44222. That's the word Rebel Broker to the number 44222. And then you will become a member of the Rebel Underground. And that's your information never gets sold. I'm not giving it to anybody else. It would be nice if I could just sort of poll the room of folks who've signed up and have them tell you how many times they've been pestered by emails as a result of signing up. I hate to be a spoiler, 0 so far, but stuff is going to be coming. It's part of the whole ramping up the show thing. It's one reason why I'm asking folks to do the survey. I'm trying to focus more into building the show so that it can be self-sustaining in terms of actually giving me more time to do more cool stuff. I've got some very interesting ideas in terms of more ways I want to help you guys see more stuff, particularly as it relates to YouTube. I've had a few people say they'd love to see stuff on YouTube other than just the show getting posted there. And there's already a plan, I promise, I swear I'm going to do it, to do the property investing tool analysis or sort of walkthrough and how I do it. And that's absolutely going to happen. I just need to find the time not only to shoot all the video, but then edit it and then do all the things I need to do to it and then post it up on YouTube. But I'm also toying with doing a series of real world, on the ground videos of me going out and looking at properties and saying, here's what I'm seeing, here's what I'm thinking, here's the numbers, trying to figure out the details of what I can and can't do. in terms of what I can and can't videotape, that type of stuff, or videotape. Boy, does that age me or what? That I can't shoot on video. But just cool things that are sort of in the mix of different ways that I want to help push you guys along or get momentum going for you in terms of your goals. Or for those of you who don't even want to do any of that junk, who just kind of like watching what goes on in real estate and seem to enjoy watching me or hearing me discuss what I'm up to in real estate, it'll be that as well. So anyway, that's a very long-winded version of stuff that's coming, but also a little bit of a sneak peek into information that the Rebel Underground is going to be getting. And they're also, once it gets rolling, there's going to be at least a once-a-month newsletter that comes out that's going to do a little bit of a behind-the-microphone thing, plus maybe a cool take on some real estate-related subject or tech relating to real estate, cool software relating to real estate, tools relating to real estate. And I'm also going to start doing a more of a book review thing. I did this years ago, and then I kind of stopped because I frankly ran out of time to read so many books. But that's stuff I want to add again, and that's all part of growing the show and paying for the ability for me to have more time to spend just on the show and the content I want to share with you all. Now, as I mentioned, I wanted to address a message I got from one of my listeners, one of you all. And I want to start with, I have never received, and including this interaction, I have never received some of that stuff that you see on the internet. No vitriol. Every time someone has contacted me who's disagreed with me, it's always been a very adult exchange, and I truly appreciate that. And I'm not saying that with the word "but" following it. I actually think this exchange was in the same vein. But when everything was said and done, it was very clear that I really just disagreed with this listener, and I'm respectful of her position. But the bottom line is I'm just not seeing it the same way that she is. So I thought I would share her original message, and there was my message back to her, and then she replied. And with her reply, it became clear that I should revisit subprime lending and the new credit dynamics that we have going on. Because there were some things in there that I profoundly disagreed with, and it's absolutely a reasonable disagreement, and folks can have varying degrees of what they think should be happening in lending. But the things that this particular listener really seems to think are a good thing to do are the bad things that got us into trouble last time. So I kind of wanted to review it. I'm not going to obviously give out any personal information about this listener. I'm sure once she hears what I read, she'll realize, oh, well, those are the words I wrote. And I told her I'd talk about it on the show, and she actually mentioned me talking about it on the show. So I feel cool with pushing forward with this. So let me just give you her original message. Hey, I really like your show, but it was hard to listen to the one about not using utility bills for underwriting mortgage loans. I know you're a rebel, but I would hope that a rebel would look for opportunities for honest, hardworking folks who care about their credit score to get access to cash, not block it. If your credit score is impacted by your history of paying utility bills, then your ability to get a mortgage based on your credit score should also be impacted by the same. Regular folks looking to get a mortgage need all the help they can get to get started in building their wealth. A utility bill payment history should not be the alternative. A utility bill payment history should not be the alternative. It should be absolutely considered because responsible people who care about their credit score should not have access to cash to be blocked and, in effect, blocked access to wealth. I hope you think about this and consider it for a future show comment. Thanks, Karen. So I responded, and I don't know how useful it is for my response. I think it would be fair. I read her words. Because I think when I walked away with a different feeling, I think, than I ultimately got when I got her response to my first message. So let me go with mine. Hi, Karen. Thanks first for being a part of the audience. I'm afraid that we may just have to respectfully disagree to one degree or another on this one. There is no element of credit associated with your utility bills. You could make a bit of an argument that it is a very small, very short-term quote-unquote loan since you're paying for services that have already been rendered. But there is where you hit the snag. You're paying for a service, not servicing a loan. If you stop paying, the service gets turned off. What's more, from the standpoint of a lender, someone paying their utility bill regularly really does not reflect on their ability to pay a larger conventional loan. This new way of calculating credit is intentionally including these kinds of expenses in a more influential way to artificially increase a person's credit score, which may feel good but ultimately hurts more than more people than it helps. I understand where you're coming from, but easy money is no favor to folks with difficulty managing their finances. The downturn literally ruined hundreds of thousands, if not millions of people across the country who really never should have been able to qualify for the levels of debt that they were taking on. Trying to help folks in that aftermath was painful to watch, and even worse when after trying to help them escape from their situation, they were left only with the bankruptcy as an option. A person's financial maturity, ability to balance a budget, and to borrow responsibly should at least in some way be reflected in their credit score. This recent change moves away from that. While your credit score has always included information, if you failed to pay these kinds of bills, more influence is being given to paying them than was done before. So you have been benefiting from paying these bills, just not to this extent. I think we both want the best for folks. I just think that this is one of those things that may feel good up front, but eventually can saddle people with debt before they are prepared to handle it, that will ruin them. Maybe our disagreement really boils down to the amount of weight given to utilities payments under the new method, not whether or not they should account at all. I hope this does not put you off the show. I'll absolutely take time on a future show to share your thoughts because I can see that they are sincerely held. Thanks, Robert. And then things went off the rails for me in terms of her response. Having your utilities cut off also artificially decreases your credit score. No, it's not artificial. If you fail to pay a bill, that is a direct reflection on your ability to pay a bill. So it should absolutely affect your credit score. The positive in your utilities, for me, paying your utility bills is like potty training. It's expected that everyone knows how to use a toilet. If you don't pay your utility bills, that's bad. In the same way that if you don't know how to use a toilet, that's bad. If you are successful at doing that, if you're successful at making your payments on a regular basis, you won't get a negative mark on your credit score. So no mark is as good as a thumbs up in this case. What they're talking about doing now, though, is taking that and giving it far more. Well, they're already doing it. They are now giving this far more weight. So I'd have to disagree with you that it's an artificial decrease in your credit score. If you fail to make payments on a thing, that absolutely, I think, speaks. And this kind of thing is absolutely base level stuff. If you're not paying your phone bill, if you're not paying your water bill, if you're not paying your power bill, those are absolutely things that should warn a creditor, this person is not able to pay these things. There's no way they're going to be able to pay what they're going to owe me. And I think one thing we need to grok here is putting ourselves in the position of a lender. I mean, what are things you'd want to know about someone who you are going to lend thousands of dollars to? You'd want to know they can pay things back, right? And you would consider it absolutely the minimum that they're already successfully paying the utilities in their life. That seems like the bare minimum. She goes on to say, so then I think we agree, and I hope you would use your bully pulpit to advocate for removing utility payments and even student loans from affecting credit score. Wow. And unfortunately, I can't, Karen. I believe the exact opposite. In fact, I believe 100% exactly the opposite as it relates to student loans. A student loan is actually your very first opportunity to prove that you can service a conventional loan. There is nothing more like a mortgage than a student loan, but with certain benefits. One, the lending starts while you're still in college, but you're not required to make payments on it. In fact, you're usually not required to start making payments on a student loan until sometime after you have graduated. Now, this is called a grace period for a student loan, and there's a bunch of different loans out there, and they have different terms in terms of periods of time that you can go after graduation without making a payment, but typically it's at least 6 months from what I'm seeing in searches online, and I'll be including a U.S. News and World Report's article that kind of breaks down, quote-unquote, the 6 little-known facts about student loan grace periods. However, I return to my original point that there is no way you should disregard a student loan. I can't think of a single reason why. What's the rationale behind not counting a student loan? I can't think of one. It's a loan that was taken voluntarily, and you signed for it, and it is absolutely your first foray. If you get one of these things, it's your first real experience with an honest to God loan. So absolutely, and whether they're problematic or not, they're not problematic because someone was forced to take one. So I'm not real sure why would we disregard student loans. She goes on to say, of course, all things being equal, we are talking about people who can afford a mortgage and is responsible with money, right? The problem is people who can afford a mortgage but made credit mistakes can use the score boost from wherever they can get it. It happens all the time with debtors at every echelon of our economy, probably Trump too, i.e. credit repair and other methods for boosting score to get the mortgage or reduce the interest rate, right? Gatekeeping the path to wealth never helped that immigrant who started with $7 in their pocket. Who gets to be the gatekeeper? Who gets to make the call? In the end, the subjectivity of the gatekeepers to wealth will only serve to maintain the status quo. Wealth only in the hands of the gatekeepers. We made mistakes as an economy and people have suffered. That's the casualty of war. That was the battle, and we've got to keep trying so more Americans have equal access to wealth, especially those who are responsible with money and are willing to put the elbow grease behind it. So we've got a lot of mixed messages here because I'm absolutely for the folks who manage their money, who can be responsible with their money, but we contradict each other. If you have to have a good credit history, and as far as I have news for you. I hate to break the news to you. Nobody gives a crap about being a quote unquote gatekeeper. The bottom line is if your numbers work, if you've got the credit score and you've got the income and your debt to income ratio is in line with the amount of money you want to borrow, you're going to get a loan. Bottom line. And the thing is, whether or not you are a good risk for a loan is 100% under your control. If you get a student loan and you make the payments on a regular basis, you're going to have good credit. If you pay your bills on time every month, you're going to get good credit. Well, you're going to say, well, what if they can't make enough money to handle all that debt? Well, whose fault is that? It's not everybody else's. It's not the bank's fault. It's not the quote unquote gatekeeper's fault. It's the person who took on the loan, right? I mean, if you need to lay responsibility for the situation at anybody's feet, it's got to be the borrower, right? I can't think of anybody else. Now, if you get turned down for a loan, you're going to know why. It's not going to be a mystery. It's going to be you have too much debt you have to service. The amount of debt you have to service on a month-to-month basis represents too much of a percentage of your monthly income. You don't have enough money to put down. And I get that these are all barriers and these are all problems. But by what we know is when we relax these things, when we make money easier to get, we make things worse. We did it. We've lived through it. Money could not have been easier to get up until 2006, 2007. We were seeing stated income. And you want to talk about the gatekeeper being asleep? That's what was happening. And we ended up in the worst real estate downturn that I think anyone in their lifetimes has seen. You could walk in and on stated income simply say, yeah, no, I make this amount of money. These are my debt there. And that's it. So you didn't have to prove anything. You could get a 110% loan. We've learned what happens when we do this. Now, one thing I'd like to point out at this point, and Karen, I absolutely appreciate you reaching out to me. I wanted to share with you my honest opinion. I'm sorry we can't agree on this. If that totally turns you off the show, I'm sorry to see you go. But the one thing I promised was I wasn't going to say things that I didn't believe just to retain audience folks, right? If you don't agree with me and you really find it frustrating and you think that you just can't listen to me, I'm sorry to see you go. But I respect your opinion and I respect where you're coming from. And I know you want to do good. But honestly, after watching what this did to folks last time, we are not doing anybody any favors by making it easier for folks to borrow money. Because remember, what we're talking about isn't so much borrowing money or getting them a house. We're talking about saddling them with hundreds of thousands of dollars of debt, where if things even go a little bit sideways, these folks are hosed. And I saw lives ruined. So I'm sorry. I want folks who are ready to take on that kind of debt to absolutely get the opportunity to take on that debt. But it's got to be underpinned by solid analysis of their financial standing. And And that's just kind of the way it is for me. We're going to cover another letter in a second, but I came across an article that I thought really came into this nicely, or dovetailed into this nicely. We're going to talk about that in just a second, but we're going to take a quick break here. So right when we come back, we're going to talk about Bank of America pushing more towards this subprime situation that we've already been through, that kind of dovetails nicely in with what we were just discussing. So hold on, we'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We spent the first chunk of the show responding to a letter from a member of the audience who, unfortunately, I had to disagree with. And I think some of the fundamentals there are really at odds in terms of what the listener thinks we should be ignoring versus what we should be counting. And we're almost 180 degrees away from each other on that one. So, we can analyze numbers. We can figure out what works and what doesn't work based on past performance. And I really think the evidence on that argument is more on my side. But of course, I'll leave that all up to you. I've done plenty of shows over the last year relating to this. I think more earlier when I changed over to doing shows this way that you can probably search on at the website. So you can head on over to therebelbroker.com and search for a show there. If you want to see some of the longer format shows where we talked about this, you can go over to Blog Talk Radio, where the show was before this. Just be ready to listen to a 3-hour show per shot, because that's what I was doing back when I was doing it live. And then, of course, the shows before Blog Talk Radio, again, we discussed it there. But I don't think those shows are available anymore anywhere because they were hosted on my personal website, and I don't that stuff's not up anymore. Anyway, so I wanted to we've already talked about an awful lot of this in terms of pushing more into this subprime lending situation. We've talked about 3% loans. We've talked about 2% loans. We've talked about 1% loans. We've talked about 0% loans that are floating around out there. And again, you're not doing anybody any favors by attacking the current problem from the standpoint of creating more buyers. You're making it worse. In fact, you're making it worse for those buyers. Because by creating more buyers in today's market, you can see all across the country, if folks want to buy, there's too much competition for current inventory. At least in the area I serve, this is still true. So by creating more buyers through this easy access, by artificially creating more buyers, by changing the rules on how you qualify and what your credit score is, and by creating these loans that are now requiring very little money down, you're artificially creating more buyers. We don't need more buyers. We've got plenty of buyers. We don't have enough inventory. So the net effect is, not only are you saddling these folks with debt they likely can't manage, you're now increasing the cost of the product they're trying to get a loan for to levels where it is extremely likely that once they have purchased it in a relatively short period of time, there's a really good chance that house will be worth less than what they paid for it. And because you're facilitating loans with such a low amount down, they will end up owing more than the home is worth. And this element alone should scare the bejesus out of everyone, because this is exactly what got us in trouble the last time. Okay, so let's... This is from Bank of America, and they've doubled down on their 3% down mortgages without insurance. And we talked about this months ago. This isn't just happening with Bank of America. Wells Fargo is doing this. A bunch of different banks are doing this. And remember, this is all independent of FHA, right, where you have to get mortgage insurance. These are doing it without mortgage insurance. Now, don't think, hey, well, that's fine. And then, because I would agree with you if you were to say, well, Robert, I don't care about that. That's absolutely fine because that's the private industry doing this. So in other words, it's not FHA, so it's not me as a taxpayer on the hook. Oh, no. Oh, no. It is indeed, because this is being done in cooperation with, is it Fannie or Freddie? I think it's Freddie, in partnership with Freddie Mac. So that all of these loans are immediately sold to Freddie Mac on the back end, and guess who's on the hook? Now, the names have changed. The names have changed on these things, but the person on the hook, once again, is y'all. You, me, everybody. And this is bad. They have expanded the quote-unquote affordable loan solution for low and moderate income home buyers. So they are aiming this directly at the folks who are most likely to be harmed the most. And I get it. I mean, I understand that people are, well, you're not harming anyone. You're facilitating their ability to purchase a home. And every realtor that I talk to is like, Robert, shut the hell up. This is creating buyers. We like having buyers because that means our listings are selling for more. We're getting more multiple offers. And that just simply means that in my marketplace, which may not be as hot and spicy as yours, I'm getting more buyers. I'm getting more clients. Great. More power to you. But I find myself, here's my problem. In 2003, 2004, I was telling my clients not to do these style of loans. I was okay with, I guess, the FHA one that was 3% because you're actually paying insurance, and there was sort of this idea of, you want to get out from insurance, so you want to pay it down so that you can then refi and you don't have the mortgage insurance. But I was advising people not to take that 110% loan. I was advising people to do the more safe and sane thing with their home purchase. Don't max out what you can buy. And I wasn't as vehement about it as I am now because I didn't have the benefit of what we've now been through. I have had folks who, and this is one reason why the aftermath of the downturn was so painful to me. I had former clients come to me and go, Robert, I really wish I had taken to heart your warnings. And, I say back to them, I wish I had warned you harder. Because even though I was concerned, because I would even say, there's no guarantee your home is going to increase in value. Everything that goes up eventually comes down. We see downturns, so you shouldn't be assuming that this is all just going to completely blow off the doors and you're going to make all this money. Assuming that will be bad. And I didn't say it strongly enough. And frankly, I didn't even believe it strongly enough. I had a feeling. I was like, this just doesn't feel right. I think these are bad instruments. I think these are poor ways to manage your purchase of a home. But because of what had been going on for 20 years, I guess I could have been forgiven for not being as strident about my warning. I don't have that benefit anymore. And none of us do. We've all been through this. We've seen it. My God, how dense do we have to be ignorant of what happened just 10 years ago? It blows me away that we are doing all the exact same stuff and expecting a different outcome. With the one difference now being, we have a less robust economy now than we did last time. There are more international shenanigans going on in terms of what's happening with Deutsche Bank in Europe, in terms of what's potentially happening with our dollar and more quantitative easing, in terms of the ridiculously high levels of debt that are going on out there. We are simply just not in this robust economy that we felt like we were in prior to the last downturn. It is still low. It's nowhere near where it was. The prices are where they were, but the strength of the underpinning economy isn't where it was. That should scare us. We're assuming commensurate levels of debt that we did back then, but underpinned by weaker economics. And do folks really disagree with me on that? Even if you're someone who totally buys into the line that things are better, are they as good or better than they were just before the downturn? We could argue levels of degrees, but I'm not thinking anybody thinks we're that good, because we're not. So what we've got here is an expansion of a program that mirrors the kind of crazy stuff we were doing back then in terms of what it is. The program, called the Affordable Loan Solution Mortgage, is a conforming loan that provides low and moderate income homebuyers access to a responsible lending product with counseling at affordable entry prices. Bank of America said Thursday that the Affordable Loan Solution Program is proving so successful in its first few months that the bank is doubling its annual commitment to the program from $500 million to $1 billion. What can we translate that into? Well, we translate that into, instead of 500 million going into it, in other words, some pool of people being given 500 million under these terms, folks who they self-identify as, low and moderate income home buyers who clearly don't have the down payment, so they're only putting down 3%, which means that if their property goes down by 5%, they owe more than the property is worth. And they're expanding it. They're doubling it. Remember what I talked about a few months back where I said what we need to look for is accelerations in the creation of the number of people who have bought irrationally. Because remember, we had years to build up that from about 2003 up until 2006 and 7 was when it really ramped up. You had crazy lending in 1999. That's really when it started. And I started to see it poking around in early 2000s, but it really became sort of mainstream after 2002. Well, and so that basically means about 3-4 years worth of buildup or creating a level of homes that are mortgaged that have been purchased with these risky instruments, these risky mortgages. Well, so now we're into year 2.5 of doing it again. We're real close to that. So anyway, I find this concerning. Let's see what we got here. Since our introduction in February, the Affordable Loan Solution Program has been meeting the needs of LMI borrowers, lower or moderate income is what that stands for, who desire a responsible mortgage product at an affordable entry point. We're especially proud of how the Affordable Loan Solution Program has become a popular choice for creditworthy first-time homebuyers, many of whom live in underserved communities. So if the numbers all make, don't get me wrong, all I'm suggesting is that we should have proper credit stuff. All these credit things should be accurately measuring what someone's credit history is. If they want to make, and they're supposedly doing financial training with this, helping folks understand their finances and get a better handle on managing their finances and all those other kinds of wonderful things. But remember, this whole 3% loan is also being mixed with the change to lending standards that we talked about a few weeks ago that went into effect. Where now, not only are we now only requiring 3% down with no insurance, with no mortgage insurance, we're also now artificially increasing FICO scores based on things that are not measures of lending, that are not measures of tending to a loan. I'm sorry, utility bills are not a loan. They just aren't. Home loans educational loans, student loans, they absolutely are. I don't understand the idea that we shouldn't count those. If we shouldn't count them, then we shouldn't provide them. I don't understand the logic behind that. In any case, Bank of America said that the program also considers non-traditional forms of credit, so exactly what I just described, to demonstrate credit history. Whenever they use that code word, non-traditional forms, that's what they're talking about. Even if they can't find anything, they'll count anything that you've made payments on, whether it was putting something on layaway or whatever. But your utilities, your phone bill, all that kind of stuff, they'll use that to boost your credit rating. Loan amounts must be within conforming loan limits, and the applicant's income cannot exceed 100% of the Department of Housing and Urban Development area median income. The loan also requires a minimum FICO score of 660. So in other words, they're specifically creating this for folks in the lower price point or the lower income point. And I have no problem with that. The only thing I want to make sure is that the folks that are getting through this have an ability to actually service the loan if things get tougher. The thing that scares me the most is when folks have no margins in this, when they've got nowhere to go. If there's any loss in value in the property, they are hosed. And managing that is terrible. If things get worse, then we come to the point where they suddenly don't see any upside to continuing to make their payments because they owe more than the home is worth. And when that happens, and I'll tell you what, when we see that happen, that is not a statement of low-income people or high-income people. When that happens, all across the board, people stop paying their mortgages. This isn't an indictment of folks who are in lower incomes. I saw plenty of folks in the downturn who were extremely well off, who simply stopped making payments on their mortgage because their property was now worth less than they owed on it. And before any weird paperwork could get filed, they'd simply buy a house down the street. Then they'd default on the loan in the house they were in. So this isn't a statement of not wanting folks who have difficulty accessing funds to be beat up on or be treated in an unfair way. All I'm saying is what we need to do is not treat money like it's a favor. It's not, and it shouldn't be. It should be one where through your actions and through your financial history, you've demonstrated that you take your debt seriously, and that when it comes to larger debts like your student loans, you're paying them off. You're paying them off on a regular basis. And as long as your monthly payment does not raise and in fact, I even talked to a lender who told me that in terms of student loans, there are already preferential lending programs you can use that will take into account what you're paying, but it won't count towards your percentage in terms of debt. So in other words, it doesn't skew you on your ratio between debt and income. So there's already special treatment that gets applied to student loans. As far as I know, now granted, this isn't something I heard from an institution. This is something I got from a lender who listens to the show. So there's already a bit of that going on in terms of showing some preferential treatment to folks who have those kinds of loans. To participate in the program, the occupant must occupy the property, and first-time buyers must participate in home buyer education through a HUD-approved housing counseling agency. I think that's very good. I think that should be... in terms of home buyer education, that should have been a class in high school, but I'm glad to see that this is something that's part of this program. Bank of America originates the mortgages through one of its sales channels with one of the bank's mortgage loan officers based in home loans offices and financial centers across the country, working directly with home buyers to originate the loans. Here's the sweet part for us all. Once the loan is originated, Bank of America sells the loans, including servicing rights, to Self-Help, which provides post-closing counseling for any borrowers who may be experiencing payment difficulties. And these are the guys who are in partnership with Freddie, and you are now responsible for the default if it happens. And it'll have to be one of those things where we have to give lots and lots of money to these institutions that are supporting this. Quote, the strength of the Affordable Loan Solution Program is how it brings each partner's special expertise together to address the barriers faced by aspiring home buyers with limited savings. Freddie Mac is committed to working with industry and community leaders like Bank of America and Self-Help to find better ways for helping eligible borrowers overcome the obstacles that stand between them and the successful long-term home ownership. And remember, what we've done is we've now created situations where less money is required up front, and we've created situations where the credit rating is now higher than it would be normally because of the new way we're interpreting through unconventional means, and we are basically recreating we're achieving the same bad setup as we did last time, using slightly different ways to do it. Instead of just turning a blind eye through no doc loans, we're now artificially making your FICO score look better. So we're screwing around with it in different places to make things look better when in reality they shouldn't. So this is all kind of frustrating, and I understand that there's definitely some emotional element to this that folks feed on, and I'm all for helping folks be able to move into a situation where they can purchase a home. But I don't think that comes from simply saying, you know what, we're gonna waive these other little pesky things that are indicators of a good borrower. We're just going to waive those off. Yeah, we can see that you've had some problems. We see you're not paying your student loan, but you know what? We're just going to ignore that. That's not the way to do this. You need to reward the folks who are handling the debt that they do have responsibly, and this doesn't do that. These strategies do not encourage good financial habits. In fact, the kinds of things that they probably teach in the class that they want you to take would really be counter to a lot of the things they're doing in these programs. Okay, so I hate to disagree with a listener, but there you go. That's the way it is. I appreciate you all spending your valuable time with me. I hope that you get at least as much value back in terms of what we talk about and the things we bring up and the things we discuss. As always, thanks for listening, folks. I'll talk to you all next time.